There is a powerful and destructive illusion that governs the world of finance, an illusion so pervasive that it has become the default operating system for millions of investors. It's the idea that in order to be successful, in order to achieve true financial freedom, you must be a prophet. You must be able to predict the future. You must know where interest rates are going, what the next inflation report will say, who will win the next election, and whether a recession is lurking just around the corner. This belief fuels a multi-billion-dollar industry of commentary, prediction, and endless noise. It fills our screens with blinking red and green arrows, with shouting heads debating the Federal Reserve's next move, with an endless cycle of anxiety and speculation. It is the great game of our time, and it is a game that almost everyone loses. But what if the secret to winning wasn't to play the game better, but to refuse to play it at all? What if the key to building lasting wealth wasn't about predicting the future, but about finding something so powerful, so durable, that it renders the future irrelevant? This is not a hypothetical question. It is the core principle of the most successful investor in human history. Warren Buffett, a man who has compounded wealth at a rate that defies logic, has built his entire empire on a single revolutionary idea. He and his partner Charlie Munger spend exactly zero time on economic forecasts. They do not have an opinion on what the market will do next month or next year. They do not care about the latest jobs report. They have liberated themselves from the tyranny of the macro forecast, from the need to be a fortune teller. Instead, they focus their entire intellect on a single, far more profitable question. Is this a wonderful business? Can it survive and thrive through any economic storm? Will its competitive advantages be stronger in 10 years than they are today? By shifting the question, they change the entire game. They move from the world of speculation to the world of certainty. Not the certainty of what the future holds, but the certainty of what a great business holds. The power to generate cash, to serve customers, and to grow in value over time, regardless of the economic headlines. This is the great liberation. This is the financial transformation that awaits anyone willing to challenge the conventional wisdom. It is the understanding that the rearview mirror is always clearer than the windshield. Trying to drive by looking at the fog ahead is a recipe for disaster. The intelligent investor, the one who seeks to build not just a portfolio but a fortress of financial security, learns to focus on the unchangeable, predictable reality of business quality, not the chaotic, unknowable future of the economy. In this journey, we are going to deconstruct this master principle. We will dismantle the machine of financial forecasting piece by piece and replace it with a robust, timeless framework for making intelligent investment decisions. We will explore the 5 pillars that hold up this philosophy, turning a simple idea into a powerful, actionable system for wealth building, risk management, and perhaps most importantly, for achieving peace of mind in a world designed to create financial anxiety. This is the path to becoming an owner of wonderful businesses, not a gambler on economic headlines. This is the final promise of value investing. The first and perhaps most foundational pillar of Warren Buffett's entire investment philosophy is a concept he calls the circle of competence. It is the bedrock upon which his refusal to forecast the macroeconomy is built. The idea is elegantly simple, yet its implications are profound. Each of us, through our experiences, our studies, our careers, develops a small area of specialized knowledge. It could be in software, in retail, in manufacturing, in insurance. Inside this circle, we have a genuine advantage. We understand the dynamics, the language, the competitive landscape. We can make judgments with a high degree of confidence. Outside of this circle lies a vast and dangerous wilderness of ignorance. The fatal mistake, Buffett argues, is to wander outside that circle. And for him, the macroeconomy, the swirling vortex of interest rates, geopolitical events, and government policy, is the most dangerous wilderness of all. He knows he cannot understand it with any degree of certainty, so he simply refuses to play in that sandbox. He stays within the small, well-lit area of analyzing individual businesses he can understand. There is no story that illustrates this principle more powerfully than Buffett's multi-decade love affair with the See's Candies Company. This was not a flashy tech stock or a complex financial derivative. It was a box of chocolates. The acquisition of See's Candies in 1972 by Berkshire Hathaway for $25 million is a masterclass in staying within one's circle of competence and ignoring the broader economic noise. The early 1970s were a period of immense economic turmoil in the United States. The nation was grappling with the end of the Bretton Woods system. The Vietnam War was winding down in a painful and divisive manner, and the storm clouds of stagflation, that toxic cocktail of high inflation and stagnant economic growth, were gathering on the horizon. The headlines were filled with fear. Pundits were predicting chaos. The stock market was entering a brutal bear market that would last for years. By every conventional measure, it was a terrible time to be making a major capital allocation. But Warren Buffett and Charlie Munger were not reading the headlines. They were reading the financials of a candy company from California. They saw a business that had a powerful, almost mystical brand connection with its customers. People in California didn't just buy See's Candies. They had an emotional attachment to it. It was the go-to gift for Valentine's Day, for Christmas, for Mother's Day. This wasn't just a product, it was a tradition. Buffett understood this on a gut level. He understood the psychology of brands and customer loyalty. This was inside his circle. He saw that See's had pricing power. Because customers were so loyal, the company could raise prices year after year to combat inflation without losing business. In an inflationary environment, this is the holy grail. While other companies were getting squeezed, See's could pass on its rising costs and then some. This too was a business dynamic Buffett understood intimately. He saw a simple business model. They made chocolates, they sold them in their own stores. There were no complex supply chains spanning the globe, no esoteric technology that could become obsolete overnight. It was an understandable, durable business. The sellers, the See family, wanted $30 million. Buffett and Munger, after analyzing the books, concluded it was worth no more than $25 million. This negotiation itself is a lesson. Even for a wonderful business, they would not overpay. They were disciplined. They nearly walked away from the deal over that $5 million difference. But finally, the sellers relented. Berkshire Hathaway acquired See's Candies for $25 million. At the time, the company was earning about $4 million pre-tax. To the outside world, fixated on the looming recession and market crash, it looked like a quaint, perhaps even foolish purchase. A candy company on the West Coast? Who cares when the global financial system is shaking? But Buffett wasn't buying the economy, he was buying See's Candies. Over the next several decades, that single $25 million investment would go on to generate over $2 billion in profit for Berkshire Hathaway, cash that required very little additional capital investment. That cash became the seed corn for dozens of other investments, fueling the growth of the Berkshire empire. Buffett himself has called See's the prototype of a dream business. It taught him the incredible value of a durable competitive advantage and the power of a brand. And it was all possible because he ignored the terrifying macroeconomic predictions of the day and focused on the simple, understandable truths of a single business. He knew he couldn't predict inflation, but he could predict that people in California would still want to buy See's chocolates for their loved ones next year, and the year after, and the year after that. He stayed inside his circle, and that decision, made in the heart of a storm of economic fear, became one of the most profitable in financial history. It was the ultimate proof that knowing a business is infinitely more valuable than guessing about the economy. The psychological principle that underpins the circle of competence is a powerful antidote to one of the most common and destructive cognitive biases, the Dunning-Kruger effect. The Dunning-Kruger effect is a type of cognitive bias in which people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. The world of stock market investing is a veritable petri dish for this phenomenon. An investor might read a few articles online about electric vehicles, watch a segment on a financial news channel, and suddenly believe they are an expert capable of picking the next Tesla. They mistake a sliver of surface-level information for deep, functional knowledge. They have wandered, with unearned confidence, far outside their circle of competence. Warren Buffett's approach is a conscious, systematic rejection of this tendency. He practices what we might call intellectual humility. He is acutely, almost painfully, aware of the boundaries of his own knowledge. His famous quote, "The most important thing to do if you find yourself in a hole is to stop digging," can be applied here. When he encounters a business or an industry he doesn't understand, he doesn't try to dig for a shallow understanding. He simply puts it in the too hard pile and moves on. This is not a sign of weakness or lack of intelligence. It is the hallmark of a profound and disciplined intellect. He knows that the financial cost of being wrong is far greater than the ego boost of having an opinion on everything. This intellectual humility combats another powerful bias, the overconfidence bias. Most people, especially in fields like finance and executive decision-making, are wired to project confidence. We believe we are smarter, better informed, and better at predicting outcomes than we actually are. This is particularly true when we experience a small amount of success. An investor who gets lucky on one stock pick may start to believe they have a golden gut, leading them to make larger, more reckless bets on things they don't truly understand. The circle of competence is a mental model that acts as a governor on this engine of overconfidence. It forces a constant self-interrogation. Do I really know enough about this industry to have an edge? Do I understand its competitive dynamics better than the thousands of other smart people looking at it? Can I explain, in simple terms, how this business will be making money 10 years from now? If the answer to any of these questions is no, the disciplined mind steps back from the cliff of speculation. Furthermore, this principle directly attacks the need for what psychologists call cognitive closure, which is the human desire to have a firm answer to a question and an aversion toward ambiguity. The endless stream of economic news and market analysis preys on this need. It offers simple, direct, and usually wrong answers to complex questions. The market is going down because of inflation. Buy tech stocks because the future is digital. These narratives provide a comforting, albeit false, sense of understanding and closure. Buffett's approach requires a comfort with ambiguity. It requires the ability to say, "I don't know," and to be perfectly fine with that. He accepts the ambiguity of the macroeconomic future and instead seeks clarity and closure in the one area where it is attainable: the analysis of an individual business's long-term prospects. He trades the false certainty of a macro forecast for the earned certainty of deep business knowledge. It is a cerebral shift from being a passive consumer of narratives to an active analyst of facts within a defined domain. This discipline is not natural. It is a learned skill, a form of mental training that separates the professional from the amateur and the wealthy from the crowd. So how can we translate this powerful principle into a practical, applied mental model for our own financial lives? The blueprint for building and operating within your own circle of competence can be broken down into a 4-step process. This isn't just theory, it's a practical instruction manual for improving your capital allocation and risk management. Step 1. The honest audit. You must begin with a brutally honest self-assessment. Take out a piece of paper or open a new document and draw a large circle. Inside this circle, you are going to list the industries and business models that you genuinely understand with a high degree of fidelity. The key here is the definition of understand. It does not mean I've heard of it or I use its products. It means you can answer a series of critical questions without resorting to a search engine. For example, if you list software, can you explain the difference between SaaS, software as a service, and perpetual licensing? Can you describe the concept of customer acquisition cost and lifetime value? Do you know who the main competitors are and what their different strategies are? If you list retail, can you explain inventory turnover, gross margin, and same-store sales? The bar for entry into your circle must be high. This is not about ego. it is about intellectual honesty. Your career is often the best place to start. If you've worked in banking for 10 years, you likely have a deep understanding of financial services. If you are a doctor, you have an edge in understanding healthcare and pharmaceutical companies. Be specific. Technology is too broad. Enterprise data storage is better. Fast casual restaurants is better than consumer goods. Your initial circle may be very, very small. That is not just okay, it is the entire point. Step 2. The expansion project. Your circle is not static. You can and should work to expand it over time, but this expansion must be deliberate, patient, and focused. Choose one industry that is adjacent to your current circle, or one that genuinely fascinates you. Now commit to a deep dive curriculum. This is not a weekend project. This is a multi-month or even multi-year commitment to becoming a genuine expert. Your goal is to read the top 5 to 10 books on that industry's history and dynamics. You should identify the top 5 companies in the space and read their last 10 annual reports, paying close attention to the CEO's letters to shareholders. You should listen to their quarterly earnings calls. You should subscribe to industry-specific trade journals. The goal is to immerse yourself in the language, the metrics, and the competitive landscape of that one specific area until it moves from outside your circle to firmly inside it. This methodical process of financial education is what separates serious investors from hobbyists. Step 3. The too hard pile. This is perhaps the most crucial and difficult step in daily practice. You must develop the discipline to create and actively use a too hard pile. As you screen for potential investments or business opportunities, the vast majority of them will fall outside your circle. It might be a biotech company with a promising but complex drug trial. It might be a cryptocurrency with a white paper you can't fully grasp. It might be a complex commodities trading operation. The temptation, fueled by hype and fear of missing out, is to take a flyer, to make an exception just this once. The disciplined investor resists this. They mentally, or physically, take that idea and place it in the too hard pile. There is no shame in this. Charlie Munger famously said that he and Buffett have a too hard pile that is enormous, containing most of the investment universe. The power comes from not wasting a single moment of mental energy on these low-probability bets. It frees up all of your intellectual capital to focus on the small number of opportunities that fall squarely within your circle, where you have a real discernible edge. Step 4. The expert test. Before you ever allocate a single dollar to an investment, you must be able to pass the expert test. The test is simple. Could you sit down with an expert in that specific field and have a credible, intelligent conversation about the industry for 30 minutes? Could you debate the relative merits of the top 3 companies, strategies? Could you explain the primary risks facing the industry over the next decade? Could you, in simple language, explain to a novice how the business makes money and why it will continue to do so? If you hesitate, if you feel a sense of intellectual fraudulence, you have not done enough work. You are still outside the circle. Passing this test is your final green light. It is the culmination of your audit, your expansion project, and your disciplined use of the too hard pile. It is the moment you move from being a speculator to an investor. The antithesis of this disciplined approach is the path walked by the overwhelming majority of market participants, the path of the 99%. This is the path of the intellectual dabbler. The dabbler operates under the illusion that to be a successful investor, one must have an opinion on everything. Their circle of competence is a mile wide and an inch deep. They are a connoisseur of headlines, not annual reports. Their investment philosophy, if one can call it that, is a chaotic patchwork stitched together from financial news soundbites, online forum hype, and the latest hot stock tips from their brother-in-law. Let's imagine the journey of this investor. We'll call him Frank. Frank starts his day not by thinking about business value, but by checking stock futures. He sees that futures are down, and his stomach clenches with anxiety. He turns on a financial news channel, and a panel of experts are loudly debating the Federal Reserve's next move on interest rates. One expert predicts a hawkish stance, which will be bad for growth stocks. Another predicts a dovish pivot, which will be good. Frank, who has a portfolio heavily weighted in the popular tech stocks of the day, feels a surge of panic. He doesn't truly understand what a hawkish or dovish stance means for the cash flows of his companies over the next 10 years, but he understands the fear in the expert's voice. Later that day, he reads an article online titled, "5 AI Stocks Set to Explode." He doesn't know anything about artificial intelligence, but the article is persuasive and full of exciting jargon. He recognizes one of the company names. He sells a portion of his high-quality, dividend-paying consumer staples stock, a business he vaguely understands because he buys its products, to fund a new position in this speculative AI company. He has just traded a piece of a business inside his potential circle of competence for a lottery ticket far outside of it, all driven by a narrative he consumed in 5 minutes. A few weeks later, a geopolitical crisis erupts overseas. The market sells off sharply. The news is filled with images of chaos and talk of supply chain disruptions. Frank, remembering the market crash of 2008, panics. He sells everything. He moves his entire portfolio to cash, telling himself he will wait for things to calm down. He feels a momentary sense of relief, the illusion of control, but calm never truly arrives. The market, which is a forward-looking mechanism, bottoms out and begins to rally long before the geopolitical news feels resolved. Frank, waiting for the all-clear signal that will never come, watches from the sidelines as the market recovers all of its losses and then some. After months of agonizing, fueled by the fear of missing out, he finally buys back in, but at prices significantly higher than where he sold. He has whipsawed himself, selling low and buying high, the cardinal sin of investing. Frank's portfolio is a graveyard of abandoned strategies and half-baked ideas. It is a direct reflection of the chaotic news cycle. His actions are not guided by a coherent investment philosophy, but by a series of emotional reactions to external stimuli he cannot control or predict. He is playing a game he cannot win because he is focused on the wrong things. He believes he is engaging in sophisticated market analysis, but in reality, he is simply gambling on the ephemeral moods of the market, which are themselves a reaction to the unknowable future of the macroeconomy. This is the path of the 99%. It is a path of high activity, high anxiety, high costs, and ultimately, low returns. It is the direct and disastrous consequence of ignoring the simple, powerful wisdom of staying within your circle of competence. The direct financial connection between adhering to the circle of competence and building long-term wealth is not abstract. It is tangible and can be measured on a balance sheet and in a portfolio's performance. The principle works like a powerful financial filter, creating a massive advantage in 2 critical areas: risk management and opportunity spotting. First, let's consider risk management. From a financial perspective, risk is not volatility, as modern portfolio theory often suggests. True risk, as Buffett defines it, is the permanent loss of capital. Wandering outside your circle of competence dramatically increases this risk. When you invest in a business you don't understand, you cannot accurately assess its true intrinsic value. Therefore, you have no way of knowing if you are buying it with a margin of safety, a significant discount to its underlying worth. You become entirely dependent on the market's mood to validate your purchase. If the stock price goes up, you feel smart. If it goes down, you have no internal conviction to hold on or buy more, because you never understood the fundamental value in the first place. This leads directly to the financially ruinous behavior of buying high on hype and selling low on fear. A portfolio built on such speculation will inevitably suffer from these permanent capital losses. In contrast, staying within your circle means you can value a business with a reasonable degree of confidence. When the market panics and the stock price of a great business you understand falls well below its intrinsic value, you see it not as a risk, but as an opportunity. This allows you to avoid panic selling and, more importantly, to buy more at bargain prices, lowering your average cost and dramatically increasing your future returns. The financial result is a portfolio that is far more resilient to market downturns and is structurally designed to profit from them, not be destroyed by them. Second, the circle of competence enhances your ability to spot unique opportunities that the broader market, with its shallow, headline-driven analysis, might miss. The market is generally efficient at pricing well-known large-cap stocks based on consensus views. But in the nooks and crannies of the market, in specific industries and niches, deep knowledge provides a genuine edge. Because you have committed to a deep dive in your area of expertise, you might recognize a shift in competitive dynamics before it shows up in the quarterly numbers. You might understand that a new product, dismissed by Wall Street analysts, is actually a game changer because you understand the end customer. This informational and analytical advantage allows you to make investments before they become obvious to the crowd. This is how significant alpha, or returns above the market average, is generated. Your portfolio's performance is no longer tethered to the S&P 500. It is driven by your unique insights. For example, a software engineer investing in a smaller, lesser-known enterprise software company might understand the stickiness of its product far better than a generalist analyst, allowing them to buy a future giant at a startup's valuation. This directly translates into a portfolio with the potential for asymmetric returns, limited downside due to the margin of safety, and massive upside due to unique insight. Over a lifetime of investing, the financial difference between a portfolio built on this principle and one built by chasing random market narratives is not a matter of a few percentage points. It is the difference between modest growth and transformational wealth building, the difference between a constant state of financial anxiety and the quiet confidence that comes from owning a collection of wonderful businesses you truly understand. The second great pillar holding up Buffett's philosophy is the aggressive and total rejection of economic forecasting. He calls this the fallacy of forecasting. While the first pillar taught us to focus our attention inward on what we can know, this pillar teaches us to actively ignore the noise coming from the outside world. The financial media is a deafening orchestra of prediction, with every pundit, analyst, and economist playing their tune about where the market is headed. Buffett's radical stance is to put in earplugs and walk away. He understands that the entire industry of macroeconomic prediction is, at its core, a grand illusion. No one has ever been able to consistently and accurately predict the movements of the stock market, interest rates, or the economy, and no one ever will. The most dramatic and instructive story of Buffett putting this principle into practice occurred during one of the darkest moments in modern American history, the financial crisis of 2008. In September of that year, the global financial system was on the brink of absolute collapse. Lehman Brothers had just declared bankruptcy, the largest in U.S. history. AIG, the world's largest insurer, was teetering. Merrill Lynch was forced into a fire sale to Bank of America. The credit markets were frozen solid. Panic was not just in the air, it was the air. The economic forecasts were not just gloomy, they were apocalyptic. Experts were predicting a second Great Depression. The Dow Jones Industrial Average was in free fall, plummeting day after day. The overwhelming consensus, from Wall Street to Main Street, was to sell everything, hoard cash, and hide. The future of capitalism itself seemed to be in question. In the midst of this carnage, on October 16, 2008, Warren Buffett did something that seemed, to many, like an act of insanity. He published an op-ed in the New York Times titled, simply, "Buy American, I Am." He began with a chillingly direct sentence. "The financial world is a mess, both in the United States and abroad." He didn't sugarcoat the situation. He acknowledged the fear and the terrible economic news. But then he made his move. He declared that he was moving his personal, non-Berkshire portfolio from government bonds into American equities. He stated, quote, "A simple rule dictates my buying. Be fearful when others are greedy, and be greedy only when others are fearful." He openly admitted that he had no idea if the market would be lower in a month or a year. He was certain that the economic news would remain terrible. But he was making a bet not on the next economic report, but on the long-term productivity of American business. This was not a market timing call. He was not predicting the bottom. In fact, the market continued to fall for another 5 months after his article was published, bottoming in March of 2009. Those who followed him immediately saw their investments lose another 25% or more. The media pundits who lived and died by short-term predictions called him a fool, said the old man had lost his touch. But Buffett wasn't forecasting the market. He was assessing value. He saw that the prices of great American businesses, the durable, cash-generating engines of the economy, had become disconnected from their long-term earning power. The panic had created a once-in-a-generation sale. While everyone else was forecasting the end of the world, Buffett was looking at the balance sheets of companies like Wells Fargo, American Express, and Coca-Cola, and he was seeing incredible bargains. He famously said in the article, "Fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have. But most major companies will be setting new profit records 5, 10, and 20 years from now." This was the crux of his argument. He was ignoring the short-term, unknowable economic forecast and focusing on the long-term, highly probable business forecast. And of course, he was spectacularly right. The market bottomed in March 2009 and began one of the longest and most powerful bull markets in history. Those who panicked and sold locked in devastating losses. Those who listened to the apocalyptic forecasts and stayed in cash missed a historic opportunity for wealth building. And those, like Buffett, who ignored the forecasts and focused on buying great businesses at fearful prices, made fortunes. The 2008 crisis was the ultimate crucible for his philosophy. In a world screaming about the end of the economy, Buffett calmly went shopping for stocks, proving once and for all that the most profitable market analysis is often no analysis at all, just a clear-eyed assessment of business value in the face of universal fear. The psychological trap that the forecasting industry exploits is our brain's deep-seated evolutionary craving for certainty. This is known as the ambiguity aversion or certainty bias. Our ancestors on the savannah who could predict where the lions would be or when the rains would come were more likely to survive and pass on their genes. This has hardwired our brains to seek out patterns and predictions, to create a narrative that makes an uncertain world feel more manageable and less threatening. The financial markets are the modern savannah, a complex, chaotic, and often dangerous environment. The economic forecaster is the modern shaman, the tribal elder, who claims to be able to read the entrails and predict the future. We are psychologically predisposed to listen to them, even when their track record is abysmal. This desire for certainty is amplified by the illusion of control. By consuming forecasts, charts, and expert opinions, we feel like we are doing something, that we are taking control of our financial destiny. It feels more responsible to be constantly monitoring the economic news than to simply buy a good business and hold it for 10 years. The activity of listening to forecasts creates a false sense of diligence. It's a psychological comfort blanket that makes us feel like we are steering the ship, even if we are just rearranging the deck chairs while being tossed by the waves of the market. Warren Buffett's approach requires us to fight this deep-seated instinct. It demands that we embrace uncertainty, that we become comfortable with the idea that the future is fundamentally unknowable. This is a psychologically difficult state to maintain, which is why so few people can do it successfully. Another powerful cognitive bias at play is the authority bias. We are conditioned to defer to the judgment of people who appear to be experts. A well-dressed economist on a major news network, speaking with confidence and using complex terminology, triggers our authority bias. We assume they must know something we don't. We fail to check their past predictions or question their methodology. We simply accept their forecast as a credible piece of information. The entire ecosystem of financial media is built on propping up these authorities. Buffett's public dismissal of them is a radical act of intellectual independence. He is essentially saying, "The emperor has no clothes." He judges ideas based on their merits and evidence, not on the credentials or confidence of the person speaking them. Finally, the availability heuristic plays a crucial role. This is a mental shortcut that relies on immediate examples that come to a person's mind when evaluating a specific topic. The financial news cycle is a fire hose of availability heuristics. A scary headline about inflation is vivid, recent, and emotionally charged. Therefore, we dramatically overweight its importance in our decision-making process. The slow, steady, and boring process of a company increasing its earnings year after year doesn't make for exciting headlines. It is not available to our minds in the same way. So we end up making major portfolio strategy decisions based on the most recent, most dramatic piece of news, ignoring the far more important long-term fundamentals. By deliberately ignoring this news flow, Buffett prevents the availability heuristic from hijacking his rational mind. He starves the bias of the data it needs to operate, allowing him to maintain focus on the long-term, less available information contained within a company's financial statements and business history. To break free from this psychological prison, we need an applied mental model, a practical blueprint for systematically dismantling the influence of forecasts on our financial decisions. We can call this the forecast inoculation protocol. It's a three-step process to build immunity to the siren song of prediction. Step 1. The Scorecard Project. The first step is to shatter the illusion of expert authority with cold, hard data. You must stop taking forecasters at their word and start keeping score. Choose 5 prominent market strategists, economists, or pundits that you often see on TV or read online. Create a simple spreadsheet. In the first column, write the date. In the second, write the pundit's name. In the third, write their specific, quantifiable prediction. For example, economist X predicts the S&P 500 will end the year at 4,200. Or strategist Y predicts a recession will begin in the third quarter. It must be a specific, testable claim. Vague predictions like the market will be volatile don't count. In the fourth column, at the end of the predicted time period, you will record the actual outcome. Was the prediction right or wrong? After tracking these experts for just 1 year, you will have created an undeniable, personalized piece of evidence. The results will almost certainly be shocking. You will see that the best and brightest minds in the industry are wrong far more often than they are right. Their collective record is likely to be no better and often worse than a coin flip. This scorecard is not just an intellectual exercise. It is a psychological weapon. The next time you hear that same pundit making a confident new prediction, your brain will no longer trigger the authority bias. It will trigger the memory of their documented failures, inoculating you against their influence. Step 2. The inversion question. This step is about rewiring your thought process when confronted with economic news. The typical reactive investor asks, "Given this news about inflation, what should I do with my stocks?" This question puts the external unknowable event in the driver's seat. The inversion question flips this entirely. The new question is, ignoring this news for a moment, has the long-term earning power of the specific businesses I own fundamentally changed in the last 24 hours? For example, does a higher-than-expected inflation report change the fact that millions of people will still drink Coca-Cola tomorrow? Does it diminish the power of Apple's brand and ecosystem? Does it make Google's search engine less dominant? In 99.9% of cases, the answer is a resounding no. The business's durable competitive advantage remains intact. By consistently asking the inversion question, you train your mind to anchor its decisions on the stable foundation of business fundamentals, not the shifting sands of economic data. It shifts your locus of control from the external world to your own analysis. Step 3. The information diet. The most effective way to avoid the poison of forecasting is to stop drinking it. You must consciously curate your information intake. This means making deliberate choices about what you read and watch. Unsubscribe from market newsletters that are focused on short-term predictions. Delete the stock market app from your phone's home screen that constantly flashes red and green prices. drastically reduce or eliminate the time you spend watching financial news channels. Their business model is to sell advertising, which requires keeping viewers hooked through excitement and fear, not to provide wise long-term counsel. Replace this junk food information with a nutrient-rich diet. Use the time you save to read one annual report a week. Read a biography of a great business leader. Read industry-specific journals to deepen your circle of competence. Listen to interviews with CEOs who are focused on building their businesses for the next decade, not the next quarter. This is not about sticking your head in the sand. It is about choosing to focus on the signal instead of the noise. Over time, this new information diet will fundamentally change your perspective. The daily gyrations of the market will seem less important, and the long-term trajectory of great businesses will become crystal clear. This is how you achieve the ultimate financial transformation: freedom from the anxiety-inducing cycle of news and prediction. The antithesis of this disciplined, forecast-free approach is the macro tourist, the investor who treats the stock market like a complex weather system that must be constantly monitored and predicted. This is the path of the 99%, and it is a journey paved with anxiety, high costs, and profound underperformance. Let's follow the story of an investor we'll call Susan, a diligent professional who is intelligent in her own field, but a macro tourist in her financial life. In late 2019, the economy was strong, and the market was at all-time highs. Susan, influenced by the optimistic consensus, was fully invested, primarily in popular index funds. In early 2020, the first whispers of a novel coronavirus began to circulate. The macro tourist's antenna went up. She started consuming news about the virus voraciously. As the pandemic exploded globally in March 2020, the economic forecasts turned from rosy to apocalyptic overnight. Economists were predicting a global depression, mass unemployment, and a complete collapse of consumer spending. The market plummeted by over 30% in a matter of weeks. Overwhelmed by fear and the barrage of terrifying forecasts, Susan sold everything. She told herself it was a prudent act of risk management. She was protecting her capital until there was more clarity. The clarity she was waiting for never came in the way she expected. The government and the Federal Reserve responded with unprecedented fiscal and monetary stimulus. The market, anticipating this massive support long before its effects were felt on Main Street, bottomed in late March and began a ferocious rally, even as the pandemic news grew worse. Susan, however, was still anchored to the grim economic reality. She saw lockdowns, rising death tolls, and long lines at food banks. The forecasts she was reading were still dire. She couldn't bring herself to buy back into a market that seemed so disconnected from the economy she was seeing on the news. She sat in cash, watching in disbelief as the market recovered all of its losses by August. By late 2021, a new narrative had taken hold. The economy was roaring back, fueled by stimulus and pent-up demand. The new forecast was for a new normal of rapid technological adoption and endless growth. The fear of the pandemic was replaced by an intense fear of missing out. Susan, having missed the entire recovery, finally capitulated. She bought back into the market near its all-time highs, chasing the very technology stocks that had performed the best. Then came 2022. The new macro villain was inflation, triggered by the very stimulus that had saved the economy. The Federal Reserve, which had been dovish, was now forced to become aggressively hawkish, raising interest rates at the fastest pace in decades. The new forecasts were for a severe recession to combat inflation. And the very growth stocks that Susan had bought at the peak were the ones that were hit the hardest. She once again found herself sitting on significant losses, paralyzed by a new set of terrifying economic predictions. Susan's portfolio is a testament to the failure of forecasting. Her every move was a reaction to the prevailing macro narrative, and she was always one step behind. She sold at the point of maximum fear in 2020, missed the recovery, and bought back in at the point of maximum greed in 2021, only to be crushed by the subsequent downturn. She paid an enormous financial price, but the emotional cost was just as high. She lived in a constant state of anxiety, her mood tethered to the latest CPI report or Fed announcement. Her experience is not unique. It is the story of millions of investors who believe that navigating the market means successfully predicting the economy. They are forever driving by looking in the rearview mirror, reacting to last month's data and last week's headlines, and in doing so, they steer themselves directly into the ditch. The direct financial connection between ignoring forecasts and superior investment returns is one of the most powerful and quantifiable effects in all of finance. Making investment decisions based on economic predictions directly leads to three distinct types of financial damage: opportunity cost, transaction costs, and tax inefficiency. First, and most devastating, is the opportunity cost. Numerous studies have shown that the vast majority of the stock market's long-term gains occur in short, explosive bursts, often immediately following periods of intense fear and negative economic news. A famous study by J.P. Morgan Asset Management, for example, demonstrated the impact of missing just the best few days in the market. An investor who stayed fully invested in the S&P 500 from 2002 to 2021 would have seen an initial $10,000 investment grow to over $64,000, a return of 9.5% annually. However, an investor who missed just the 10 best days during that same period would have seen their return cut by more than half, ending up with only about $29,000. Missed the 30 best days, and the return becomes negative. These best days are almost impossible to predict, as they frequently happen when the economic forecasts are at their most dire, think March 2009 or April 2020. The investor who is out of the market waiting for clarity is virtually guaranteed to miss these crucial days. The financial consequence is not just underperformance, it's the failure to achieve meaningful wealth building over the long term. The cost of being wrong is catastrophic. Second are the transaction costs. The macro tourist who is constantly shifting their portfolio strategy in response to economic news is engaged in a high level of activity. They are frequently buying and selling, often paying brokerage commissions on each trade. More subtly, they are paying the bid-ask spread every time they transact, which is a hidden cost that slowly erodes capital. Over years and decades, this constant churning, driven by the folly of forecasting, acts as a significant drag on performance. A buy-and-hold investor focused on business quality makes very few decisions and incurs minimal costs. Their portfolio is not leaking value through constant friction. This simple, direct financial advantage of inactivity, enabled by ignoring forecasts, adds up to a substantial sum over an investing lifetime. Finally, there is tax inefficiency. In the United States, investment gains are taxed at different rates. Long-term capital gains on assets held for more than a year are taxed at a much lower rate than short-term capital gains on assets held for less than a year. The investor who is trading in and out of the market based on macro predictions is almost always realizing short-term gains, which are taxed at their higher ordinary income tax rate. This means a significant portion of any winning trades is immediately given up to the government. The long-term investor who buys a great business and holds it for a decade or more not only benefits from the power of compounding, but also defers taxation for years. When they finally do sell, the gain is taxed at the much more favorable long-term rate. Ignoring forecasts and adopting a long-term mindset directly translates into a more tax-efficient portfolio, allowing your capital to compound on a pre-tax basis for longer. The financial impact of this is enormous. It's a structural advantage that the macro tourist, with their short-term focus, can never hope to achieve. The bottom line is clear: engaging in economic forecasting is not just a philosophical error. It is a direct and quantifiable drain on your wealth. Having established the importance of staying within your circle of competence and ignoring the noise of macro forecasting, we arrive at the third pillar, which is the heart of the entire system: identifying the all-weather business. If you are not going to bet on the economy, you must bet on something else. That something else is the durable competitive advantage, or what Buffett famously calls the moat. An all-weather business is a company with a protective moat so wide and so deep that it can withstand economic droughts, inflationary floods, and the constant siege of competitors. Finding and owning these businesses is the entire game. The focus shifts completely from what is the economy going to do to what makes this specific business so powerful that it can prosper in any economy. One of the most compelling and illustrative examples of Buffett identifying and investing in an all-weather business is his initial major investment in the Coca-Cola Company in 1988. This story is a masterclass in looking past short-term market events and focusing on the timeless quality of a business franchise. The backdrop was the infamous stock market crash of October 19, 1987, known as Black Monday. The Dow Jones Industrial Average fell by over 22% in a single day, the largest one-day percentage drop in its history. The crash sent shockwaves of fear through the global financial system. In the months that followed, the consensus view was one of extreme caution. Economic forecasts were grim, with many predicting a severe recession. Investors were terrified, and the memory of the crash paralyzed Wall Street. It was a time of immense uncertainty, a time when most people were selling stocks, not buying them. Warren Buffett, however, was doing his homework. He was not reading the economic tea leaves. He was studying the history and the financial power of Coca-Cola. He saw a business that was the epitome of a durable competitive advantage. First, he identified its colossal brand. Coca-Cola was not just a beverage. It was an icon, a piece of American culture that had been exported to the entire world. The name itself was a synonym for happiness and refreshment in hundreds of languages. This brand created what he called a mind share that was virtually impenetrable. In a blind taste test, people might prefer another cola, but at the point of purchase, they would ask for a Coke. This was a moat built not of bricks and mortar, but of decades of consistent advertising and positive emotional association. Second, he analyzed its business model. Coca-Cola itself didn't own the messy, capital-intensive bottling plants around the world. It was primarily in the business of selling syrup, a secret formula, to its vast network of bottlers. This was an incredibly high-margin, capital-light business. It was like a toll road on global refreshment. For every bottle sold, a small, high-profit tribute flowed back to the headquarters in Atlanta. This structure allowed the company to generate enormous amounts of free cash flow. Third, he saw its global growth runway. While Coke was dominant in the United States, Buffett recognized the immense potential in international markets, where per capita consumption was still a tiny fraction of American levels. He saw a product that was cheap, non-discretionary for many, and had universal appeal. He could envision a future where billions more people around the world would be drinking Coke, regardless of who was president or what the Federal Reserve was doing. So in 1988, in the fearful aftermath of a historic market crash, Buffett began to act. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire a substantial stake in the Coca-Cola Company. At the time, this was a massive capital allocation for Berkshire. The market was still skittish. Pundits questioned the wisdom of making such a large bet on a boring old company when the economic future was so uncertain. But Buffett wasn't betting on the next year's GDP. He was betting that in 10, 20, and 50 years, more people around the world would be drinking Coca-Cola than they were in 1988. He was betting on the moat. That $1 billion investment became one of the cornerstones of Berkshire Hathaway's wealth. The stock appreciated dramatically over the following decade, and just as importantly, it gushed dividends back to Berkshire, providing the capital for future investments. The Coca-Cola story is the perfect embodiment of the third pillar. Buffett completely ignored the terrifying, short-term macro forecasts that paralyzed the rest of the investment world. Instead, he focused his entire analysis on the simple, powerful, and enduring business characteristics of a single company. He found an all-weather business, bought it at a reasonable price during a time of fear, and then simply held on, letting the power of its competitive moat do the heavy lifting of wealth creation for him. The underlying psychological principle that makes the concept of an all-weather business so effective is that it directly counters our brain's action bias. Action bias is the tendency to favor action over inaction, even when inaction is the more rational course. In the world of investing, this bias is constantly stoked by the financial media. The message is always to do something in response to the latest news. Buy this, sell that, rebalance your portfolio. This frantic activity feels productive, but as we've seen, it often leads to poor outcomes. The philosophy of owning an all-weather business is fundamentally a philosophy of intelligent inaction. The strategy is to do the hard work of identifying a truly great company up front, and then to have the discipline to do nothing for a very, very long time. This approach leverages a much more powerful yet psychologically difficult concept, the power of compounding. Compounding is the process where the returns on an asset, from either capital gains or interest, are reinvested to generate additional earnings over time. Albert Einstein reportedly called it the eighth wonder of the world. However, the human brain is not wired to intuitively grasp exponential growth. We think in linear terms. We underestimate how quickly a sum of money can grow when it's left to compound in a great business over decades. Action bias is the enemy of compounding. Every time an investor sells a great business to chase a new idea or to react to a scary headline, they interrupt the compounding process. They reset the clock to zero. They not only incur costs and taxes, but they forfeit the explosive, backloaded growth that comes from long-term ownership. Furthermore, focusing on a company's durable competitive advantage helps to mitigate recency bias, our tendency to overweight the importance of recent events. When a recession hits, recency bias causes investors to believe that bad times will last forever. They sell their stocks because they extrapolate the recent negative trend far into the future. Conversely, during a bull market, they believe the good times will never end and pile into speculative assets at inflated prices. The concept of a moat forces a longer-term perspective. It prompts you to ask questions that transcend the current economic cycle. What was this business doing 10 years ago? What allowed it to survive the last recession? What is the probability that its core advantage will still be intact 10 years from now? This long-view historical thinking acts as a psychological ballast, keeping you steady when the winds of recency bias are blowing a gale. It anchors your analysis in the enduring characteristics of the business, not the fleeting emotions of the market. Choosing to invest only in all-weather businesses is therefore a psychological discipline. It is a pre-commitment to long-term thinking and a deliberate choice to let the miracle of compounding work its magic, shielded from the destructive impulses of our own action-biased and short-sighted brains. Translating the search for an all-weather business into a practical blueprint requires a systematic checklist for identifying and evaluating a company's economic moat. This is the investor's guide to becoming a moat detective. The process can be broken down into identifying 5 primary sources of durable competitive advantage. First is the intangible asset moat. This includes powerful brands, patents, or regulatory licenses that are difficult or impossible for competitors to replicate. A brand, like Coca-Cola's, creates pricing power and customer loyalty that transcends the product itself. To apply this, ask, does this company's name allow it to charge more for a product that is functionally similar to its competitors? Would customers feel a real sense of loss if this brand disappeared? For patents, like those held by a pharmaceutical company, the moat is legally enforced but has a finite lifespan. For regulatory licenses like those required for credit rating agencies or waste management companies, the government itself creates a high barrier to entry. Your task is to identify the intangible asset and assess its durability. Second is the switching costs moat. This exists when it is too expensive, time-consuming, or risky for a customer to switch from the company's product to a competitor's. Think about the software that runs a large corporation's payroll system. Even if a slightly better or cheaper alternative comes along, the cost and risk of migrating the entire company's data and retraining thousands of employees are immense. The company is effectively locked in. To identify this moat, analyze the customer's experience. Ask, how much effort would it take for a customer to stop using this product and start using a rival's? Is the product deeply embedded in the customer's workflow or daily life? High switching costs lead to predictable, recurring revenue streams, which are the hallmark of a great business. Third is the network effect moat. This is one of the most powerful moats, especially in the digital age. A business has a network effect when the value of its product or service increases for each new user that joins. Think of a social media platform like Facebook or a credit card company like Visa. The more people who are on Facebook, the more valuable it is to you as a user, because you can connect with more people. The more merchants that accept Visa, the more valuable the card is to consumers, and the more consumers who have Visa cards, the more essential it is for merchants to accept it. It is a virtuous cycle that creates a winner-take-all dynamic. To spot this, ask, does the service become better as it gets bigger? Does growth in the user base create a more powerful barrier to entry for potential competitors? Fourth is the cost advantage moat. This is when a company can produce and deliver its products or services at a consistently lower cost than its rivals. This can stem from proprietary processes, superior scale, or access to a unique resource. A low-cost retailer like Costco uses its immense purchasing volume to secure better prices from suppliers, which it then passes on to its members, creating a cycle of loyalty and growth. A mining company that owns the richest and most accessible ore deposit has a structural cost advantage that can't be replicated. To evaluate this, you must dive into the company's operations and financials. Ask, what is the source of the company's cost advantage? Is it sustainable, or can competitors eventually match it? Fifth, and finally, is the scale moat. This is related to cost advantage, but is more about dominance in a specific niche. A company that has a massive distribution network, for example, might have a scale advantage that makes it uneconomical for a smaller player to compete. Think of a railroad that owns the only track between two major cities. This local or regional scale can create a powerful and enduring monopoly. Your blueprint is to take any potential investment and run it through this 5-part filter. Does it have a moat? If so, what is the source of that moat? How strong is it? And most importantly, is the moat getting wider or narrower over time? A business with a wide and widening moat is the all-weather fortress you are looking for. This rigorous qualitative analysis is far more valuable than any economic forecast. The antithesis to seeking all-weather businesses is the path followed by the 99%, chasing story stocks and hot dots. This investor is not a moat detective. They are a narrative addict. They are drawn to companies with exciting stories, revolutionary technologies, and charismatic CEOs, often with little regard for the underlying business economics or competitive landscape. Their portfolio is a collection of lottery tickets, not a fortress of durable franchises. Let's consider the example of an investor we'll call David during the dot-com bubble of the late 1990s. The narrative of the day was the new economy. The story was that the internet was changing everything, and old metrics like profits and cash flow were irrelevant. All that mattered was growth, capturing, quote, eyeballs, and having a .com at the end of your company name. David was fully bought in. He ignored established, profitable, old economy companies like the ones Buffett favored. They were boring. The future was online. He invested heavily in companies like Pets.com. The story was compelling. It was going to revolutionize the pet supply industry by selling directly to consumers online. It had a catchy name and a famous sock puppet mascot that even appeared in the Super Bowl. It was a hot dot. What David didn't analyze was the moat, or rather, the complete lack of one. There were no significant barriers to entry. Anyone could set up a website to sell pet food. The company had no cost advantage. In fact, its costs were enormous. It was famously losing money on every sale because it was selling heavy bags of dog food below cost and then paying to ship them across the country. There were no switching costs and no network effects. It was a terrible business model wrapped in a brilliant story. Another one of his favorites was Webvan. The story was even grander. It was going to revolutionize the grocery industry with online ordering and one-hour delivery. The company raised hundreds of millions of dollars and built massive state-of-the-art warehouses. But again, David was seduced by the narrative and ignored the business realities. The logistics of last-mile grocery delivery are incredibly complex and capital-intensive. Webvan was burning cash at a breathtaking rate. It had no sustainable competitive advantage, only a great idea that was decades ahead of its time and its own operational capabilities. When the dot-com bubble burst in 2000, investors like David were wiped out. Pets.com and Webvan, along with hundreds of other story stocks, went bankrupt. Their stock prices went to zero. The narrative had evaporated, and there was no underlying profitable business to cushion the fall. David had not been investing in businesses. He had been speculating on stories. The path of the 99% is to confuse a good story with a good business. They are mesmerized by the promise of the future and fail to do the rigorous, often boring work of analyzing the competitive advantages of the present. They buy stocks that are going up because they are going up, and they are drawn to companies that everyone is talking about. This strategy works brilliantly until it doesn't. And when it fails, the losses are often total and permanent, a catastrophic result of choosing an exciting narrative over a durable moat. The financial connection between owning a portfolio of all-weather businesses and achieving superior long-term returns is profound and direct. It manifests on a company's financial statements in the form of higher profitability, greater consistency, and superior returns on capital. A company with a wide moat, by definition, has protection from the brutal forces of competition. This protection allows it to do something that companies in competitive industries cannot: maintain high profit margins. A business in a commoditized industry, like an airline or a standard steel mill, has to compete almost entirely on price. Any excess profits are quickly competed away. A company with a powerful brand or high switching costs, however, has pricing power. It can raise its prices to offset inflation or to simply increase its profitability without losing a significant number of customers. On the income statement, this translates directly into a higher gross margin and a higher net profit margin. Over time, these higher margins mean the company generates significantly more cash relative to its revenue. This cash generation leads to the second key financial indicator, a consistently high return on tangible capital. Return on capital is a measure of how efficiently a company is using its money to generate earnings. A great business with a capital-light model, like Coca-Cola selling syrup or Microsoft selling software licenses, can grow its earnings dramatically without having to reinvest huge sums of money into new factories or equipment. They can take the enormous profits they generate and use them to buy back stock, increasing each shareholder's ownership percentage, or pay dividends. This is the financial dream. A business that grows while simultaneously gushing cash back to its owners. On a balance sheet and cash flow statement, you can see this. The company's assets don't need to bloat in order to grow its sales and profits. This financial efficiency is a direct result of the moat and is the engine of long-term value creation for shareholders. The financial impact on your portfolio is twofold. First, the stocks of these businesses tend to be less volatile. Because their earnings are more predictable and less cyclical, their stock prices often hold up better during recessions and market downturns. They provide a defensive characteristic to a portfolio. Second, and more importantly, they are compounding machines. The combination of high returns on capital and the ability to reinvest cash at those high rates creates an exponential growth trajectory for the company's intrinsic value. Owning a collection of these businesses means your portfolio's value is not dependent on the market's fickle mood, but is instead being driven upward by the underlying, relentless financial performance of the companies themselves. You have effectively hitched your financial wagon to a team of powerful, self-funding, and well-protected workhorses. The financial difference between this and owning a portfolio of cyclical, low-margin, capital-intensive businesses is the difference between taking a steady escalator to wealth and being trapped on a terrifying financial roller coaster that often ends up right back where it started. The fourth pillar of the Buffett-Munger approach is a principle that elegantly ties the first three together. It's the famous maxim, "Price is what you pay, value is what you get." Once you have identified an all-weather business that sits squarely within your circle of competence, the job is not yet done. Even the best business in the world can be a terrible investment if you pay too much for it. This pillar is about discipline. It's about separating the quality of the business from the price of the stock and having the patience to wait until the price is favorable. This discipline is the final barrier that protects an investor from the emotional tides of the market, particularly the mania of greed that can sweep through Wall Street. A powerful and telling anecdote that illustrates this principle is Buffett's long and patient courtship with the Gillette Company. For years, throughout the 1980s, Buffett openly admired Gillette. He saw it as a textbook all-weather business. It had a dominant, world-renowned brand. Its core product, razor blades, created a brilliant razor and blades business model, where the initial razor was sold cheaply to lock in a customer, who would then buy high-margin replacement blades for years. This created incredibly high switching costs, not because it was difficult to switch, but because of habit and brand loyalty. He understood the business. It was simple, predictable, and generated enormous amounts of cash. It was squarely within his circle of competence. However, for much of the 1980s, Wall Street also loved Gillette. The stock price was high, reflecting the market's appreciation for its wonderful business characteristics. By Buffett's disciplined calculation of its intrinsic value, the stock was simply too expensive. He would not let his admiration for the business seduce him into overpaying for its stock, so he did one of the hardest things in investing. He waited. He watched the company perform, he continued to study it, but he did not buy. This is the path of the professional. The amateur gets excited about a company and buys immediately, afraid of missing out. The professional separates the analysis of the business from the act of purchasing and waits for the price to offer a margin of safety. His opportunity finally came in 1989. Gillette was facing a hostile takeover attempt from the Coniston Partners, a corporate raider. To fend off the takeover, Gillette's management needed a friendly, long-term investor. They needed a white knight. They turned to Warren Buffett. Because Gillette was in a vulnerable position and needed a large injection of capital quickly, Buffett was able to negotiate a special deal that was not available to the general public. He invested $600 million in Gillette preferred stock. This special stock paid a handsome dividend and, more importantly, was convertible into common stock at a very attractive price down the road. He had finally been able to buy into his dream business, not at the high price quoted on the stock market, but at a fair, even bargain price that he was able to negotiate because he had the cash and the reputation to be a savior in a time of crisis. This story reveals two critical aspects of the price versus value pillar. First, the discipline to wait. For years, he was willing to suffer the psychological pain of watching a stock he loved go up without him because the price was not right. Second, the preparedness to act decisively when the opportunity arises. Market panics, corporate crises, or general pessimism can create moments when the price of a great company's stock becomes temporarily disconnected from its long-term value. The disciplined investor, who has done their homework for years and has cash ready, can step in during these moments of turmoil and make the investments that will define their career. Buffett's investment in Gillette became enormously profitable for Berkshire Hathaway, but the profit was not earned in 1989 when he wrote the check. It was earned during all the years he patiently waited for Mr. Market to offer him a price he was willing to pay. The psychological principle that the price versus value discipline helps to overcome is perhaps the most powerful and socially driven bias in all of finance, herd behavior or social proof. Humans are social creatures. We have a deep-seated instinct to follow the crowd. In ancient times, if everyone in your tribe suddenly started running, it was a very good survival strategy to start running too, and ask questions later. This instinct is still wired into our brains, but in the modern stock market, it is financially lethal. When a stock's price is rising rapidly, it creates a powerful social proof. Everyone is buying it, everyone is talking about it, everyone is getting rich from it. The fear of being left out, the fear of looking foolish while your neighbors are celebrating, becomes overwhelming. This is the engine of speculative bubbles. The price versus value mantra is a direct antidote to this herd instinct. It forces you to anchor your decisions not on the actions and opinions of the crowd, but on your own independent calculation of a business's intrinsic value. This creates what we might call an internal locus of control. Your sense of whether an investment is good or bad comes from your own analysis, not from the fluctuating price on your screen. When the herd is buying and pushing prices to irrational highs, your value calculation tells you to stand aside. When the herd is panicking and selling, pushing prices to irrational lows, your value calculation tells you it's time to buy. This is the very essence of contrarian investing. It is psychologically excruciating. It means being willing to look wrong in the short term to be right in the long term. It means buying when every instinct in your body, fueled by social proof, is screaming at you to sell. This discipline also combats anchoring bias, our tendency to rely too heavily on the first piece of information offered. For many investors, that anchor is the current stock price. They look at a stock that has gone from $10 to $100 and anchor on the idea that it is a, quote, winner. A value investor ignores the price history. They build their estimate of intrinsic value from the ground up, based on future cash flows. Their anchor is not the market price, but their own calculation of value. This allows them to see a stock that has fallen from 100 to 50 not as a loser, but as a potentially great business that is now on sale for half price. By forcing an independent calculation of value, this pillar liberates the investor from the psychological distortions created by herd behavior and faulty mental anchors. It is the framework for rational, independent thought in an arena that is fundamentally driven by mass emotion. The applied mental model for implementing the quote, price versus value discipline is the concept of the margin of safety, famously articulated by Buffett's mentor, Benjamin Graham. The blueprint is to build a valuation process and then to demand a significant discount before you buy. It's a three-step action plan. Step 1. Calculate intrinsic value. This is the most analytical part of the process. You must build a conservative estimate of what the business is actually worth, independent of its stock price. While complex discounted cash flow (DCF) models are one way to do this, a simpler and often more effective method for most investors is to use a private buyer mindset. Ask yourself, if I had the money to buy this entire company, what would I be willing to pay for it? A straightforward way to approximate this is to look at the company's owner earnings, a concept Buffett defines as net income plus depreciation and amortization, minus the average annual amount of capital expenditures needed to maintain the business. Once you have a conservative estimate for owner earnings, you can assign a reasonable multiple to it. A stable, high-quality business might be worth 15 to 20 times its owner earnings. A more cyclical or lower-quality business might be worth only 10 times. The key is to be conservative in every assumption. Your goal is not to find the exact right number, but to arrive at a reasonable range of value. Step 2. Demand a margin of safety. This is the crucial step that separates value investors from everyone else. Once you have your estimate of intrinsic value, you do not buy the stock when it trades at that value. You wait until it trades at a significant discount. This is your margin of safety. Benjamin Graham recommended a discount of at least 33%, meaning you would only buy a stock valued at $100 per share if its price fell to $67 or less. Buffett has often demanded a 40% or even 50% discount, especially for businesses with more uncertainty. This discount is your protection against bad luck, errors in your judgment, and the unpredictable turmoil of the world. It's the suspension bridge engineer overbuilding the bridge to be able to handle 10 times the expected load. It's the difference between investing and speculating. Buying at a deep discount provides two benefits. It minimizes your potential downside if you are wrong, and it maximizes your potential upside if you are right. Step 3. The patience protocol. The final step is to codify your patience. After you have valued a business and determined your margin of safety price, you write it down. Then, you set a price alert with your brokerage. And then, you do nothing. You go on with your life. You study other businesses. You wait. You resist the temptation to cheat and buy it a little higher because you're afraid of missing it. You let the market come to you. This might mean you go months, or even a year or two, without making a new investment. This is a feature, not a bug, of the system. The margin of safety approach ensures that you only swing at the fat pitches, the rare, no-brainer opportunities that the market occasionally serves up. This protocol transforms you from a frantic market participant into a patient, calculating hunter, waiting for the perfect moment to strike. The antithesis of this patient, value-driven approach is the path of the momentum chaser. This is the 99% of the market that operates under the belief that the trend is your friend. They are not concerned with intrinsic value. Their only metric is the direction of the stock price. They buy stocks that are going up simply because they are going up, assuming that the upward momentum will continue. This strategy can feel brilliant and exhilarating during a bull market, but it is a recipe for catastrophic losses when the tide inevitably turns. Let's revisit the dot-com bubble as a prime example. The momentum chaser in 1999 was not analyzing the business models of companies like Cisco Systems or Qualcomm. They were simply looking at the stock charts, which were going up in a near vertical line. Cisco was a great business, a real all-weather company that built the backbone of the internet. But in late 1999 and early 2000, its stock price became completely detached from any reasonable calculation of its intrinsic value. It briefly became the most valuable company in the world, with a market capitalization of over $500 billion. The momentum chaser, seeing the relentless upward price movement and fueled by the social proof of everyone around them getting rich, piled in at the top. They paid a price that reflected not just the company's brilliant future, but a future that was impossibly perfect. They confused the great business with a great stock. When the bubble burst, Cisco's business did not go away. It remained a profitable, important technology company. But its stock price collapsed by over 80%. The momentum chaser who bought near the peak saw their investment decimated. It would take them over 15 years just to get back to even, a disastrous outcome that destroyed a decade and a half of potential compounding. The same story played out with countless other hot stocks of the era. The momentum chaser's portfolio is a story of buying at the point of maximum excitement and optimism, which is almost always the point of maximum price and minimum future return. This behavior is not limited to tech bubbles. It happens in every sector and every cycle. It's the investor who bought housing stocks in 2006, energy stocks at the peak of the oil price in 2008, or the trendy concept stocks of 2021. Their methodology is to look for what is popular and rising in price, and their portfolio is a graveyard of past manias. They are constantly buying high, hoping to sell higher, and are left holding the bag when the narrative changes and the momentum reverses. They have paid a high price, and what they have gotten is a painful lesson in the difference between a stock's price and a business's value. The direct financial connection of the price versus value principle is the most important driver of long-term investment returns. This is not a theoretical concept, it is mathematical certainty. Your future return on any investment is inversely correlated with the price you pay for it. The higher the initial price, the lower your subsequent return, and vice versa. Let's quantify this. Imagine a great, stable business that you have accurately valued to be worth $100 per share. It earns $10 per share per year, giving it a price-to-earnings PE ratio of 10 at its intrinsic value. If you buy the stock at its intrinsic value of $100, your initial earnings yield is 10%, $10 in earnings divided by your $100 investment. Assuming the earnings grow at a modest 5% per year, you can expect a very respectable long-term return of around 10 to 15% annually. Now, consider the momentum chaser. They buy the same stock during a period of market euphoria, when its price has been bid up to $200 per share, a PE ratio of 20. The business is still the same, earning $10 per share, but the momentum chaser's initial earnings yield is now only 5%, $10 in earnings divided by their $200 investment. For them to achieve the same return as the value investor, the stock's valuation would have to continue to expand, or its earnings would have to grow at a much faster rate than is realistic. More likely, the valuation will eventually revert to its historical mean, causing the stock price to fall even if the business continues to perform well. The high price paid acts as a powerful gravitational pull, dragging down future returns. Finally, consider the disciplined value investor who waits and buys the stock during a market panic at $50 per share, a PE ratio of 5. Their initial earnings yield is a staggering 20%, $10 in earnings divided by their $50 investment. They have locked in a massive structural advantage. As the business continues to grow and the market sentiment eventually returns to normal, they will benefit not only from the earnings growth but also from the PE ratio expanding from 5 back to its normal level of 10 or higher. This double whammy effect, the combination of a high initial earnings yield and the potential for a rising valuation multiple, is what generates the extraordinary, multi-bagger returns that define the careers of legendary investors. It is the direct financial fruit of the margin of safety. Your brokerage statement will ultimately reflect this simple truth: the profit is made on the buy. The price you pay is the single greatest determinant of your financial success. This brings us to the fifth and final pillar of the Buffett philosophy, a principle that serves as the capstone for the entire structure, the inactivity principle. In a world that glorifies action, speed, and constant engagement, Buffett's most radical and powerful idea might be his profound belief in the virtues of sloth. He famously said, "The stock market is a device for transferring money from the active to the patient," and lethargy bordering on sloth remains the cornerstone of our investment style. This pillar is not about being lazy. It is about the strategic and disciplined application of inactivity. Once you have done the hard work of identifying a great business within your circle of competence and purchased it at a price that provides a margin of safety, the most profitable action is very often no action at all. The ultimate anecdote to illustrate this principle is the story of Buffett's longest-held and most cherished investment, his ownership of American Express. His journey with this company did not begin in crisis like with Coca-Cola or Gillette, but his commitment to it through multiple crises is the real lesson. Buffett first invested in American Express in the 1960s following the salad oil scandal, a classic case of buying a great business when it was under a temporary cloud of trouble. But the true test of the inactivity principle came much later. Over the decades, Buffett simply held onto his large stake, allowing the power of the business's moat, its powerful brand and global payments network, to work its compounding magic. Consider the major crises American Express has faced since that initial investment. In the 1990s, there was the Boston Fee Party, when a group of restaurants revolted against Amex's high fees, threatening its core business model. The stock plunged. Many investors panicked and sold. Buffett did nothing. Then came the dot-com bust and the 9/11 attacks, which devastated the travel industry, a core driver of Amex's revenue. The stock was crushed again. Buffett did nothing. Then came the 2008 financial crisis, which threatened the entire global payments system and led to fears about Amex's credit exposure. The stock fell by over 80% from its peak. It was a terrifying decline. The media was filled with predictions of the company's demise, And yet again, Buffett did nothing. He didn't even trim his position. In fact, Berkshire Hathaway provided additional capital to the company during the crisis, doubling down on its long-term belief. Why was he able to remain so inactive in the face of such terrifying price declines and negative news? Because his original thesis had never changed. He had not bought the stock based on a forecast of a smooth, uninterrupted future. He had bought it because he understood its durable competitive advantage. Through all these crises, people still wanted the prestige and security of the American Express brand. The global network of merchants and cardholders remained intact. The moat was still there. He understood that these events, while painful, were temporary storms that a truly great business could weather. He knew that selling a wonderful business because of a temporary problem or a scary headline was a loser's game. Each time, his patience was rewarded. After each crisis, American Express not only recovered, but went on to new all-time highs. The compounding continued, uninterrupted. His massive stake in the company has generated tens of billions of dollars in value for Berkshire shareholders. This incredible result was not achieved through brilliant trading, market timing, or reacting to the news. It was achieved through the discipline of inactivity. It was the result of making one good decision to buy a great company, and then decades of lethargy bordering on sloth. This is the ultimate proof that in long-term investing, your behavior is more important than your intellect. The patience to sit still, to let the compounding machine do its work, is the final and perhaps most powerful source of an investor's edge. The psychological principle that the inactivity principle helps us master is the management of our own emotions, specifically by combating loss aversion. Loss aversion is a cognitive bias, first identified by Daniel Kahneman and Amos Tversky, which describes how, for most people, the pain of losing is psychologically about twice as powerful as the pleasure of gaining. A $1,000 loss feels as bad as a $2,000 gain feels good. This asymmetry makes us incredibly risk-averse when it comes to paper losses in our portfolios. When a stock we own goes down, the pain of that loss is intense. The natural human reaction is to stop the pain by selling the stock. This is why so many investors end up selling at the bottom, locking in a permanent loss from a temporary decline. The inactivity principle is a pre-commitment to override this powerful instinct. By deciding in advance that your default action is no action, you create a powerful psychological barrier against panic selling. You are essentially telling your emotional brain, "I have already done the work. I have analyzed the business. I have confirmed its moat. I have bought it with a margin of safety. The price decline is noise, not signal. My job now is to sit on my hands." This shifts the burden of proof. The active investor feels they need a reason to hold a stock. The inactive long-term investor believes they need an overwhelmingly powerful reason to sell one. The only valid reasons are if the original thesis was wrong, if the company's moat is deteriorating, or if you have found a demonstrably better investment opportunity. A scary headline or a 30% drop in price is not a valid reason. This principle also leverages the power of the endowment effect, our tendency to value something more highly simply because we own it. While this can be a negative bias, in this context, it can be harnessed for good. By viewing yourself not as a trader of stock tickers, but as a part owner of a real business, you develop a psychological attachment. You wouldn't sell your family's successful local business just because the local economy had a bad quarter. You would think like an owner with a multi-year time horizon. Adopting this owner mindset for your publicly traded stocks transforms your relationship with them. They are no longer blinking quotes on a screen but stakes in real, productive enterprises. This change in perspective makes it psychologically easier to hold on through the inevitable volatility, allowing you to reap the long-term rewards of ownership and combat the destructive, pain-driven impulse of loss aversion. The blueprint for applying the inactivity principle is a simple but powerful framework called the portfolio garden model. Think of yourself not as a stock trader, but as a patient gardener. Your job is to cultivate a small, concentrated garden of wonderful businesses. Step 1. Plant carefully. This is the culmination of all the previous pillars. You do your research, you stay in your circle of competence, you identify an all-weather business with a deep moat, and you wait patiently to plant your seed, buy the stock, when the price offers a significant margin of safety. Because this process is so rigorous, you will not plant many seeds. A successful portfolio garden might only have 10 to 20 carefully selected plants. This concentration is a key part of the strategy. It forces you to be highly selective and ensures you know each of your holdings intimately. Step 2. Water and weed. Once a seed is planted, your job is not to frantically dig it up every day to see if it's growing. Your job is to simply monitor the health of the plant. In portfolio terms, this means spending a few hours each quarter reviewing the company's earnings reports and listening to the conference call. Your goal here is not to react to the quarterly numbers themselves, but to answer one simple question. Is the long-term story still intact? Is the moat getting wider or narrower? This is the weeding process. If you find clear evidence that a company's competitive advantage is eroding, for example, a key patent is expiring and there's no replacement, or a new competitor is fundamentally disrupting the industry, then and only then do you consider selling. This is like removing a diseased plant to protect the rest of the garden. Step 3. Let the flowers grow. This is the hardest part, the strategic inactivity. The vast majority of the time, your review will confirm that your great businesses are still great businesses. In these cases, your job is to do absolutely nothing. You do not sell your winners to lock in profits. This is like cutting your most beautiful flowers to water the weeds. The very nature of long-term investing is that a small number of your holdings will account for a vast majority of your total returns. These are your 10-baggers, the plants that grow into giant oaks. Selling them early is the single most common and destructive mistake an investor can make. You must have the discipline to let your winners run, to let them compound for years, even decades. Your portfolio will become lumpy, with 1 or 2 positions growing to represent a large percentage of the total value. This is not a sign of poor risk management. It is the sign of a successful long-term strategy. The portfolio garden model transforms your mindset from one of frantic activity to one of patient cultivation, allowing the miracle of compounding to work its magic. The antithesis of the patient gardener is the hyperactive trader, and this is the path walked by the vast majority of the 99%. This individual believes that the key to success is activity. They are constantly tinkering, rebalancing, and trading, convinced that they can outsmart the market through sheer effort. Their portfolio is not a garden. It is a revolving door. Let's imagine the hyperactive trader, Tom. Tom subscribes to multiple trading services and has his brokerage app set to send him constant price alerts. He starts the year with a portfolio of solid, blue-chip companies. A few months in, one of his stocks, a high-quality software company, is up 25%. Tom, afraid of giving back his profits, sells it. He takes his small gain and immediately looks for the next big thing. He hears a lot of chatter online about a speculative biotech stock that has a big drug trial announcement coming up. He doesn't understand the science, but he loves the story and the excitement. He plows his profits from the software company into this new bet. The drug trial fails, and the biotech stock plummets 80% in a single day. He has successfully cut his flower and used the proceeds to fertilize a weed, which promptly died. Meanwhile, another one of his original holdings, a consumer goods company, has a disappointing quarter. The stock falls 10%. Tom, influenced by loss aversion, can't stand the pain of seeing the red on his screen. He sells it to cut his losses, telling himself he can always buy it back later. Of course, the business's long-term prospects were fine, the bad quarter was a blip, and the stock recovers and goes on to new highs without him. Tom's portfolio is in a constant state of churn. He is always chasing what's hot and selling what's not. His brokerage statement at the end of the year is a long list of small wins, which he loves to talk about, and a few catastrophic losses that he tries to forget. More importantly, he has incurred significant transaction costs, and, because he never holds a stock for more than a year, all of his small gains are taxed at the highest possible short-term rate. He is running on a financial treadmill, putting in enormous amounts of time and emotional energy, only to end up with results that are far worse than if he had simply bought his original portfolio and gone on vacation for the year. He has mistaken activity for progress and motion for achievement. The hyperactive trader is constantly playing the market's game, and as a result, the market constantly transfers his money to the patient investor who is playing a different game entirely. The direct financial connection between inactivity and wealth creation is one of the most underrated but mathematically powerful forces in finance. It creates a massive financial advantage through three main channels: the maximization of compounding, tax deferral, and cost minimization. First and most importantly is the uninterrupted power of compounding. Let's quantify the cost of cutting your flowers. Imagine you invest $10,000 in a wonderful business that compounds at 15% per year. If you simply leave it alone for 30 years, that initial investment will grow to over $662,000. Now imagine an investor who sells that same stock after it has doubled in about 5 years, locking in a $10,000 profit. They then have to find another investment that can perform just as well. The chances of consistently finding such opportunities are incredibly small. More likely, they will move the money into a lower returning asset or make a mistake on their next pick. By selling, they have not just forfeited the future gains, they have broken the exponential growth curve. The difference between the patient holder and the profit taker is not a small amount. It is the difference between a comfortable retirement and life-changing wealth. Your brokerage statement will show that the biggest long-term winners are almost always the ones you bought and held. Second is the immense financial benefit of tax deferral. As we discussed, short-term trading leads to high tax bills. The patient, inactive investor enjoys a massive, government-sanctioned advantage. By not selling their winners, they allow the entire pre-tax amount of their investment to continue compounding year after year. The money that would have been paid to the IRS in capital gains taxes remains in the portfolio, working for them. This creates a larger capital base on which future returns are generated. It's like having an interest-free loan from the government. When they do finally sell, perhaps decades later in retirement, the gains are taxed at the much lower long-term rate. The financial impact of compounding on a pre-tax versus a post-tax basis over several decades is staggering. It is a structural advantage that can add hundreds of thousands or even millions of dollars to a portfolio's final value. Finally, there is the simple, direct benefit of cost minimization. The hyperactive trader is constantly paying frictional costs, commissions, bid-ask spreads that act as a steady drag on performance. A 1 to 2% annual drag from overtrading might not seem like much, but over 30 years, it can consume nearly half of a portfolio's potential value due to the negative compounding effect. The inactive investor avoids these costs almost entirely. Their capital is not being slowly eroded by friction. Every dollar is working for them. On a financial statement, this is the simplest advantage to see, yet it is the one most often ignored by those who believe that more activity equals better results. The financial truth is the exact opposite. In the world of long-term investing, inactivity is not a vice, it is the ultimate financial virtue. You have just journeyed through the 5 foundational pillars of an investment philosophy that has stood the test of time, a system built not on speculation or prophecy, but on the timeless principles of business analysis and human psychology. You have acquired more than just information. You have been given a complete mental toolkit, a macro-insulation shield, designed to protect your capital and your peace of mind from the chaotic and anxiety-inducing world of economic forecasting. You now understand the power of staying within your circle of competence, the folly of listening to forecasters, the imperative of seeking all-weather businesses, the discipline of demanding a margin of safety, and the profound wealth-building virtue of inactivity. This is a framework that liberates you from the need to have an opinion on the market's next move and empowers you to focus on the one thing you can control, the quality of the businesses you choose to own. But mastering this shield, learning what to ignore and how to protect yourself from the market's emotional tides, is only the first half of the equation. It is the defense. Building true generational wealth requires an equally powerful offense. Buffett's system is not just about avoiding mistakes. It's a complete, interconnected framework for proactive, intelligent action. You have built the foundation, but the skyscraper of financial freedom is yet to be designed. You have learned how to identify a great business in principle, but the specific, quantifiable financial metrics that separate the good from the truly exceptional, the 10 baggers from the slow plodders, represent a deeper layer of knowledge. You have constructed the fortress walls, but now you must learn to command the army within them. The video that is now appearing on your screen is not just another video. It is the next piece of the map. It is the architectural blueprint for that skyscraper. It bridges the gap between the qualitative principles you have just mastered and the hard, quantitative analysis that underpins every great investment decision. It is the link that connects the philosophy of what to look for with the practical, numerical toolkit of how to find it. It moves beyond the story and into the numbers, revealing the specific financial ratios and balance sheet characteristics that Buffett and Munger look for to identify the world's most profitable compounding machines. Others will now click away, satisfied with the shield they have built, and will go back to the endless cycle of news and anxiety, their journey incomplete. But you have come this far because you are not like them. You are not a passive consumer of financial entertainment. You are an architect of your own financial destiny. The choice you make in this moment is not about watching one more video. It is a commitment to completing your mental arsenal. It is a decision to move from defense to offense, from principle to practice. The path to mastery is a series of deliberate steps. You have just taken the first. The next one is right in front of you. Complete the map. Continue the ascent.